Let's bring in our next guest now. We have Mr. George Heber Joseph joining in, who's CIO and Chief Executive Officer Equity at ASK Investment Managers. George, we were just discussing the shape of the currency market, which continues to weaken. And, I think the macro concerns, now the money markets are pricing in very well, not just here in India, around the world. We're seeing yields harden. My question to you is that has the equity market priced it in adequately?
It's a very interesting time. If you look at the markets have not priced in for the worst case scenarios, which slowly is playing out at this point in time. Probably when we look at dissect the markets into large cap, mid cap, small caps, earnings growth profiles are different, and that is expected to be different, and that's why the valuations are where it is. When we look at from that angle, to me, the large caps have priced in for the probably lot of case scenarios which markets is expecting. But when you think about the mid and small caps, that is not the case. If you look at the energy crisis, which is perching up, which is quite, remarkably negative for the equity markets, because the bond yields are reacting, as you rightly said, to those scenarios. U.S. bond yields have moved up, and the expectation is there could be a rate hike. Those kind of thoughts have already kicked in. Whereas in the case of India equity markets, because of the extensive flows which we are seeing in the SIPs from the domestic mutual funds, that is actually keeping the mid and small cap space up. So as an investor, when I look at from valuation perspective as well as growth, what it is doing, and the macro risk and the liquidity, what it clearly tells me that maybe there is a case for looking at disparately the large cap space, and that is looking more attractive to me.
So you're saying that you would rather be in large caps than in mid caps at this point?
Yeah, obviously. So mid caps and small caps have to be very, very selective, because the growth, if you see the price to book valuation of small cap index is 3 times. Mind you, when the taper tantrum was there in 2013, it was trading at 0.6, 0.7 time price to book. So the valuations are significantly north of the expectations, given the macro risk, what is visible at this point in time. The narrative there is that, small caps and mid cap companies can grow faster, and that is already priced in as well. So to me, the liquidity risk, which can potentially unfold in the mid and small cap space, given the macro risk around energy as well as US debt scenario, which is significantly indebted US government, which is a very risky proposition on the macro side. So when you look at valuation, liquidity, and plus the under ownership, from all 3 perspectives, it looks large cap is a place to be in at this point in time.
But George, the problem is in large caps. I mean, a huge chunk of that segment is financials. And financials are getting more and more nervous as oil prices remain elevated. What's your sense of the recent selling that we've started seeing now on bank stocks? I mean, people are probably also rushing to take profits, especially PSU banks have had a great rally in the last 1 year. But if oil prices remain as elevated, if yields remain as elevated, and if we get those rate hikes, then what happens to financials?
Yeah, so I agree with your point. Obviously near-term downside risk because of the sentiment impacts can be high, but obviously macro challenges is what drives some of the near-term impact and valuations of banking sector. But if you look at most of the private banks are priced in very, very attractively, because last 5 years there were not much of run-up in these stocks. When I look at 5-year returns in many large cap private banks is 0%, and which is a very interesting scenario. Whereas PSU bank index has already moved up 5 or 6x. The situation currently, I would say there's a lot of negativity around the banking sector, and that's when the opportunity also smiles at you. So when valuations are on your dear on your side, and it is much more dearer than what it used to be, especially because of the context, what we are talking about, the energy crisis and macro challenges. These are all pricing in for very, very attractive scenarios. So to me, that is a pocket. And mind you, the credit growth also has been picking up for the last 4, 5 fortnights, about 15%, which is a very good scenario for some of these larger banks to start performing. So to my mind, the large cap private banks is pricing for the worst scenarios, whereas maybe some correction in the PSU bank would happen because of the leveraged positions they have. But I would say overall the large cap PSU bank weightages are also significantly lower. So overall, large cap as a basket from a liquidity standpoint and valuation standpoint, to me, many of them are available at 5-year low valuations, which looks attractive.
Okay, so you're saying from a longer term perspective, some of these banks are looking attractive. George, what else? I mean, the other overhang or the problem with being in the large cap space is NIT. So banks will probably go through a bit of a patch of if credit growth slows down, depending on these rate hikes, etc. But you've explained to us that you'll still buy them. The other large segment is IT, which has again a massive, massive growth issue. How are you looking at that sector?
So IT is again, it's interesting time. The jury is yet to be out. What exactly happens to these companies. Ultimately, Indian market has only IT services companies, not technology per se companies. So as the technology will get used more and more, the services will only increase. That has been the experience over the last 20, 30 years, what we have in the IT sector of Indian IT services companies. So we are quite constructive at this juncture. And ultimately, when these stocks are available at significant free cash flow yield as well as the valuations are on your side at this point in time, that's when it looks attractive. So with a value mindset, and when you think about from a next 2, 3 years window, it looks attractively positioned. So my learning over the last so many years is that when the valuations are on your side, which is more on specifically you can target and invest looking at the valuations and also the growth prospects. Today, most of the IT sector stocks are not pricing in any growth, and that gives you a very good cushion. When we speak to a lot of experts, what they say is that what people are estimating what will happen because of Anthropic and so the noise around the IT sector is that what people think which will happen in 6 months happen after 6 years, and that has been the trend. And I think stocks are pricing in for the worst case scenarios, and the growth is almost like negligibly priced in at this point in time. So to me, a surprise on growth will change the narrative of the sector, which looks to me at a very attractively priced in situation. And it is all high cash flow, free cash flow generating businesses, and that is not changing anytime soon.
Okay, got that point.
And
George,
one
finally,
more
I
thing,
mean, you also
if you
talk
look,
about. Sure, go on, go on.
so if you look at one more thing, if you look at there are commodities, engineering, capital goods, defense sectors, all these are all part and parcel of the large caps as well. So some of the mid and small cap might have an edge over there because of the size and being small and things like that. But if you look at from a cyclical construct perspective, we keep looking at decadal cycle. 2020 onwards, reflationary trade started, and that is still going on. And in our view, the space what you need to be in is the commodity engineering, PSU banks, or the financials. That cycle still will hold good from a next 2 to 3 year perspective. So the decadal cycle which started in 2020, the cyclical rally which started, which I think will continue, looking at the scenario of the inflation, looking at the scenario of the interest rates movement, to me that cycle still holds on and probably continue till 2030. So we are of the view that you have to pick and choose whether it is in mid cap or small cap. In the cyclical sectors, engineering, capital goods, the financials, and also the proxies of the manufacturing benefits that India can get from the China plus one strategy, which most of the countries will follow. So all of them looks interesting. Only thing is that India is considered to be an anti-AI trade, which to me is also good benefit of from a FI perspective. The day when they think to come back to India, because India is the highest growth market in the world, and the day they come back, again the large caps segment looks interesting to be well poised to capture the upside.
Yeah, I mean, and the only problem is that we don't know really when that's happening, right? It's just, it's been almost
Yeah,
now
it's too difficult
one and a
to
half years,
comprehend,
more than one and a
but
half years of waiting.
yeah. Yeah, it's too difficult to comprehend, and I think
Yeah.
right now there is no mood because the currency impact. There is no mood for any FI. When I talk to them, they are not in a mood to think about India. But that's where the opportunity also lies, right? So when valuation is on your side, so as a fund manager, where do I bet? I need to bet on the right valuations rather than expecting that
Yeah.
the SIP flows will continue and so on and so forth. So I need to think about the right valuations and right growth profiles.
So, George, my last question to you is this, that, so far, the market's just about 10% off the peak. So what we've seen is more of a time correction, barring this war when the price correction became very swift. Otherwise, it was just, a grinding market, time correction, which can get very frustrating, but it's not scary. It's frustrating, but not scary. Now, going forward, next couple of months, do you think it'll be more of the same, range-bound markets? Or do you see a bigger price correction ahead? Because overall, you are cautious. You're being in large caps. You're acknowledging the macro risks. So at an index level, what to expect over the next few months?
Next few months is always difficult to predict, but if you look at what is the biggest problem that I see today, the risk associated with the US, right? And the trade war, or US trying to capture Venezuela, or now the Iran war, all are an after effect of the US debt going up significantly, right? $39 trillion debt, $2 trillion of fiscal deficit yearly, current account deficit, all of them bulging up. US is in a almost like a fragile situation. So whether you like it or not, that is the biggest risk I can see at this point in time, which will have a ripple effect on across markets. Now, how US have tamed down the similar situation in 1985 to 87, if you look back, they were actually devalued the currency, and the debt holders had to take the brunt. Now this time around, that also looks very difficult, even though many currency experts expects that there is a devaluation in US dollar can happen suddenly, like what happened in 1985 to 87, and then the balls start rolling. But this time around, the debt holders are mainly China, Japan, and Europe, which are not, probably China is not in a mood to accept the devaluation. So to my mind, that is the biggest risk associated with the markets, and which I don't know how it tantamounts to of inflation rise and things like that. So unless otherwise that problem is solved, I don't think the markets is going to be in a very stable zone to invest and make money. So I'll be very cautious from that perspective. And
Yeah.
therefore, you look for the valuation opportunities. You might not like the large caps because it's boring. And, in a PMS construct like ASK, it is not very interesting to talk about, invest in large caps and things like that. But we have to focus on, where the valuations are on your side and liquidity is on your side, right? So that is where I think there is a significant amount of optimism getting built in the mid and small cap space, even though time correction has happened. But the valuation is not corrected enough because of the flows of the mutual funds to the mid and small cap space.
Yeah. All right. Points well taken, George. Good to be with you this morning. Thanks for joining us. Morning where, it's a bit of a sobering reality really in the market today. We're down about 300 points in the Nifty as the equity space gets in sync with the reality that the money market anyway has been pricing in, which is the high value of oil at this point. Thanks for being with us, George. Have a good day, and we look forward to more interactions soon.
Thank you. Thank you. Have a nice day to you as well.
Okay. Thank you so much. Well, as we're winding down this edition of Opening Bell,